So the topic is called cost of capital. Okay. Do you remember that, we have been discounting all the cash flows using the cost of capital to calculate whether the project is feasible or not. So if we got a NPV positive, then we said we are covering the cost of capital. So that means we are getting a positive net present value. So just look at on your screen. These are various projects which we have, and how much investment we are going to make, that is given in the column B. Then of course, when you're going to start the project, you're going to get some money out of it. You start a project, then you start earning something after the project has been fully installed, put into use. Then you start getting some money out of it. It can be a project to start a new plant. It can be a project to start a new machine, a power saving equipment, anything you want to, or maybe a computer software, anything. You are just installing it and spending some money, and you get some kind of a revenue, which is cash flow, in terms of savings or in terms of adding to your profit loss account as your revenue as sales. Okay. So 50,000 you have spent, and you're going to get 10,000, 15,000, 20,000, 18,000, and 10,000. So we are assuming that each of the project which have been listed as projects number 1 to 8, they have a life of 5 years. Okay, fine. So then what we do is we calculate the present value of these cash flows, because these cash flows are available in 5 different years, assuming that they are available at the end of the year. Okay, so we discount them using the calculating the present value. Here we have assumed 12%, okay, as the cost of capital. The cost of capital is 12%. If you can see at the top, that's the cost of capital. So at the cost of capital, I am calculating the present value. Okay, fine. Which means that we have covered the cost of capital. Whatever the cost of capital the company has spent, it has covered it. So now this, which means that you have spent 50,000 and you're getting 52,236 in the first project. So NPV is positive, which means that you should go ahead and do the project, because it is meeting the expectation of all the stakeholders of the company, which is who are providing capital to the company. So they are being their cost has been covered. So you're getting an NPV positive, which means the formula here would be the investment minus the present value. So we'll get NPV. Is that okay? Have you following? Okay. Then we calculate the IRR, where we used basically to calculate what kind of return the project is giving. Okay. So the project is giving 13.73%. So here we just use the formula called IRR, if you can see at the top, and highlighted all the cash flows. Okay. Fine. From B3, right from here to here, we calculated the IRR. Is that okay? Fine. So the IRR is coming 13.73%, and your cost of capital is 12%. So this is a second mechanism through which we appraise a project or a business. So here you're getting 13.73%, which means your cost of capital is 12%. So you're getting 13.73. So you should do it. So NPV is also showing the same, kind of a positive value, and IR is also giving you a green signal, isn't it? That this project is okay. Now, then we calculate MIR. Now, since the IRR has some inherent this thing, that it assumes that all the cash flows which you are getting every year, they are getting redeployed at the same rate what this project is giving. But maybe that the cash flows which you are getting may not be deployed in the same project, may be deployed in some other project. So MIR assumes that the cash which you are generating every year, surplus, okay, which the project is giving you, all that cash is getting deployed at the cost of capital. Then we recalculate the MIR, which comes to 12.98. So here we adjust, okay, that the cash flow which we are getting every year, that is getting redeployed at cost of capital, not that the return which the project is giving. Okay, so you get 12.98, still greater than 12%. So which means that we should go ahead with the project. Then, so based on all these three parameters, we got the answer that we should accept it, the first project. Is that okay? Fine. So that is what we did. We calculated, NPV, IRR, MIRR, and then we calculated the discount payback period and discounted payback period. So this is all what we did last time. Okay. So of course it has no relevance to what I'm doing now, but it was just to give an idea about what we did last time, and we used the cost of capital. to discount the cash flows. Okay. Now we are going to understand what is this, cost of capital. For each company, there will be a different cost of capital. Each business has different cost of capital. Okay. Depending upon certain things. So we are going to talk about that. So today we begin the chapter cost of capital. Any questions with regard to, the understanding of capital budgeting, IRR, MIRR, and net present value? Okay. No, not 5 years. It is. I said I am assuming the life of these project is 5 years. It can be 10 years. It can be 7 years. It can be only 3 years. Suppose you are buying some. हाँ. So what is the life of the project? अगर आपने suppose you have bought an equipment. Suppose you have bought an equipment. The life of the equipment is just 2 years. After that, you have to discard it. So you assume that what cost you are going to spend and how much returns you are going to get in 2 years. Okay, in terms of savings or in terms of additional revenue for the company, and then you are going to apply the mechanism, whether IRR, NPV, or the MIR. Okay, is that okay? So next time there is going to be a quiz from this. Okay, fine. So be prepared. Just go through the video and everything, so you'll understand. So I'm not going to spend time again in explaining that, but you can ask any question at the moment. Is it okay? Have you understood everything? Any questions you can ask me. We did it in a great, detailed fashion last time, but in the second lecture we calculated the cash flows. How do we calculate the cash flows? Of course, we did some questions, but I may do one or two more questions before your end terms, because there will be a question from that cash flows. How do we determine the cash flows? But today we move on to yet another topic, which is called cost of capital. So each company has its own cost of capital. Hero Motocorp or Hero, any company of yours, will have different cost of capital. Each company will have a different cost. Reliance will have different cost of capital. Hindustan Unilever will have, name any company, they will have their own cost of capital. Okay. Now, how does the cost of capital differ from company to company? So we are going to talk about that. So let's begin with some basics, and then we try to calculate the cost of capital for any company. Okay. So that because cost of capital becomes a very important tool, because we are going to discount those cash flows to understand whether we should go ahead to do the project or not. Fine. So if it is 10%, can be 15%. So if it is 15%, then many of the projects will not be able to survive. But if you use 10%, then most of the projects will look very good. Fine. But it all depends upon your company, what kind of business you are doing. Just to give an idea, any company which is more riskier, okay, will have a higher cost of capital. Any company which is less riskier will have a low cost of capital. Now, what do you mean by riskier or non-riskier? Now, just to give this idea about it before we understand, the companies whose cash flows are quite volatile, okay, means that it is in a business which is cyclical in nature, okay, or a company which is into consumer discretionary product. For example, where the where the customers or where the people use their discretion to buy their products. For example, car, house, airlines, hotels. So these are they are into the goods and services they are giving, which we use only when we require and when we are comfortable with our pocket. If the economy is doing well and we are into a job, so we will feel secured, and the interest rates are coming down, we buy a car, we buy a house, because the EMIs comes down. But when the economy is in doldrums, when our own when we are living in a kind of a recession kind of a situations, when we are not very sure about our own jobs or own security, then we don't buy those things. Okay, we defer our decision. Interest rates are high, EMIs are higher, so we don't buy those products. Okay, so those companies are considered to be in a business which are riskier, which will have more ups and downs in the businesses as the economic cycle plays out. Okay, but there are businesses which are into consumer staples product. Like FMCG companies, Hindustan Unilever, Dabur, or pharma companies. Those companies basically produce products where we don't use our discretion, we buy them. Okay, whatever is the state of economy, interest rates go up, it doesn't matter, because we have to buy a shampoo or a kind of a comb or anything. medicine. So we keep buying them. I mean, irrespective of the state of the economy. So their companies, are not volatile. Their cash flows, the revenue which they generate are not. They keep going up. I mean, of course, in a very not a linear fashion, but they keep growing. Okay, as a smooth this thing upward. Like if you see Hindustan Unilever, sales, it's growing. Okay, every business sales is growing, but they will have not, ups and down in their businesses. Okay, so which means on an, I mean, to understand that the businesses which are more riskier, whose volatile, whose earnings or cash flows are volatile, they will have a higher cost of capital. And then, when appraising a project or a business, a higher cost of capital will lead to only those the new kinds of projects which meet the criteria. Even after discounting those cash flows which the business is going to generate at a higher cost of capital, if they're still able to generate a surplus, NPV positive, or a return which is far greater than the cost of capital, then only we will implement them. Otherwise, we will not. So, what is cost of capital then? How do we calculate that? Okay. Now, cost of capital, there are various kinds of models which has been, determined over the years. There are various kinds of models which have been determined. Okay, but they are not, so accurate, or they cannot give you any mathematical formula cannot give you the cost of capital, isn't it? So there is a limitation. But still, we have certain models which has been given by the various economists. People, have done a lot of research. So we'll talk about that. It has its own limitations, but once we understand, then we can have, apply our own, we can control for them. Basically, we can use them, okay, to calculate the cost of the capital, and then we can just apply our, sense to see whether the cost of capital is okay or doesn't require any kind of adjustment. Okay, so कौन पढ़ता था last time? You can read, yeah.
So, learning objectives understand the concept of cost of capital that impacts the capital investment decisions for a business. Understand what are different sources of capital like debt, equity shares, preference shares, etc. Understand what is the cost of employing each of these sources of capital. Know what is weighted average cost of capital, overall cost of capital for a business.
So basically, these are the things which we are going to study. Understand the concept of cost of capital. Okay, that impacts the investment decisions for a business. So, the cost of capital is going to impact the business decision, whether we should go ahead with the project or not. Now, what are the various kinds of sources we use? We use basically, either share capital, equity, or debt, or preference shares. We can use, mainly when we do business, we get capital from two sources. Either we put our own money, which is equity, or we borrow from there. So there are two kinds of, major categories of, capital sources. One, you put your own money, or you get more shareholders to the company so that they contribute. And the second one is you can borrow money. Either take a loan from the bank, or if you're a big company, you can float your own debentures or bonds and ask people to buy those bonds so you get money. So each source of, capital will have its own cost. So we're going to study, what is the cost of equity, what is the cost of a bond or a cost of a loan, okay, cost of preference shares. So, a company uses mix of, all the sources. So ultimately, it is a weighted average cost of capital which matters for the company. Suppose, assuming that the company is using 50% debt and 50% equity. 50% it is borrowing, 50% it is, using its own money. That's the equity. Suppose the cost of debt is, say, 10%. Suppose the company has taken a loan from a bank which is charging 10%. And companies' equity shareholders, they expect around 15% return from that company. So what will be the weighted average cost of capital? It will be 50% of 10%, that is 5, and 50% of 15%, that is 7.5. So weighted average cost of capital will work out to be, in a very simple manner, 12.5%. Is that okay? Is that clear? So now, various sources of finance: shareholders' funds, equity share capital, accumulated profits of the company, preference share capital. So these are the various sources of the share capital. Okay. Borrowing from outside, debentures, bonds, or loans from banks. Okay, so we can just look at these sources from a site. If you go to a site called Screener, so you can look at any company. For example, look at, for example, Reliance. So we go to the balance sheet to look at how they're using the funds. So it is written here, uh, equity capital, reserves, that is the accumulated profits of the company, and the borrowings. Is that okay? So you can see, the last number which has been published is September 2023. So company had, 6,766 crores of share capital, okay, and reserves of 7 lakh 44, 7 crore, 7,44,456 crores. So this was the total share capital. So share capital would be then 744 plus 6. So their own money is 7 lakh 50,000 crores. Okay. Whereas the borrowing is 3 lakh 16,000. Is that okay? So, so if you can just go through, the if you look at the share capital and reserves have been growing. Okay. So company, how the company is being financed basically is that, reserves are growing, isn't it? And even the share capital has grown from around 3,000 crores to 6,000. So they have doubled their share capital, and the reserves have also been going up from almost like, less than 2 lakhs to now 7 lakh 44,000. So reserves, how they're generated, the company earns profit every year, and they pay some dividend. The rest of the money goes as reserves. So that means these are accumulated profits of the company, retained profits of the company, which the company has not declared dividend, but has used it for expanding their business. Is that correct? Have you understood? So, again, the reserves can be again when the company comes and issues fresh share capital. So it may issue share capital with at a premium, okay, because the company is already existing. So company has given rights issue to its existing shareholders. It has even come up with an FPO. That means, it raise the money again by issuing shares to the public. So when it issues shares, it doesn't issue at 10 rupees. It will issue at some kind of a higher price than 10 rupees, which is the face value. Fine. So it may charge some premium. So that premium also goes to the your reserves. So reserves can be, is boosting up because of the profits which the company has earned in past, but not declared them as dividends, or because of share premium which they have collected from subsequent issue of shares to the public or to certain, investors. Okay. And borrowings, if you look at the borrowings have been also growing from 1 lakh crore to 3 lakhs. But compare, last year it was 4.5 lakhs, but they have repaid a lot of money as loan. So they're left with now 3 lakh 16,000 crores. Is that clear? Fine. So now if you look at, this main chart, Reliance Industries. So if you look at debt equity ratio, 0.42, which means 42 paisa is debt against 1 rupee of equity. Fine. So when they use debt, if you use excessive debt, it's not always good. So, but you should use a certain amount of debt, but not all as debt. Okay, like companies like Adani and other, they were being told that they are using too much leverage. They are using so much of debt, so the companies become riskier. Yeah. No, it is debt to equity 0.42, where the arrow is there. This one. Okay. So how do we calculate that? We can just use our calculator and calculate. Very simple. Just go to the balance sheet, okay, and look at debt. Okay, it is 3 lakh 16,697. 3 lakh 16,000. Oh, sorry. 316697. So this is the debt. Now we divide this by, say, 7. I'm just adding this 751. So I've added this 67 plus 744. Okay, and I've just rounded off. Okay, this will be like this. The top two figures. this plus this is 750. So I've just made it 750. I mean, without doing full calculations. So then it comes to 0.42. Is that okay? So that means 0.42 debt against 1 rupee of equity, which you look here, 0.42. Are you getting it?
Debt to equity and debt to equity ratio is same or both are different? That is clear. You totally clear to me. This is debt to equity. Debt to equity ratio is different from debt to equity.
Come again with your question.
सर मेरा कहना ये है कि जो डेट टू इक्विटी आपने बताया अभी 0.42 का निकाला दैट इज क्लियर
हाँ
लेकिन डेट टू इक्विटी रेशियो भी आता है ना 1:2 का 1:3
हाँ, वो यही तो है, 0.4:1 है ये.
सेम है
Same 0.42 is to 1. You can say that.
ठीक है
If you say 2 is to 1, then 2 is debt, 1 is equity. So it's the same thing.
ठीक है
Okay, fine. Is that clear?
क्लियर
So let's get here. So company can use, shareholder funds. Company can borrow the money. Okay, as we have seen in case of Reliance, you can see any company. Then if you look at, this chart, which says, how much, some companies, I did it about, I think 6 months back, figures keep changing. So equity capital borrowing is given, debt to equity ratio is given. Okay. So Adani Enterprise, the debt to equity is 2.98 compared to, Reliance, which was just 0.42, which means like, almost 3 debt, 1 equity. So company is in, debt, leverage. So that's why, it was a charge was there against the company. The company is using too much of borrowed capital, and borrowed capital, using borrowed capital is riskier because you have to service the debt. You have to pay interest on that. Whereas equity shareholders, you have to give dividend, but it's not mandatory. You may not give. You may even plow back the money back into the business, or if the company is not earning, so there is no, kind of a stipulation that the company need to pay a dividend. So here, so company debt to equity ratio is this. Tata Power, which is 2.3. Like you look at Reliance, it's 0.40. Fine. Adani Green, 7.42. So Adani Group, most of the companies, they're using too much of leverage. That's why the company become riskier. If something happens to, Adani business, then the companies can go into, bankruptcy. Because if they're not able to pay loan to its bankers, or from wherever they have got the loan or borrowings, or maybe they have issued some bonds, if they're not able to, service them, then they can go to the court and seek for liquidation of the company. So there is a bankruptcy risk associated if you have more and more debt. So business becomes riskier. Okay. Now the interest coverage ratio. On the right hand side, there is something called interest coverage ratio. That means company is earning 1.7 times more than what they what they are earning. Okay, interest coverage ratio 1.7. So whatever is the interest and whatever is the earning, so their earnings are 1.7 times than the interest. Okay, look at, for example, Reliance. It's more in comfortable situation. They are earning 5 times more than what they are paying as interest. Okay, whereas Adani is paying 1.7. So any company which is less than 3 is considered to be in a not in a very good situation. It should be at least minimum. The thumb rule is that it should be more than 3 to 4. Okay, fine. So if you look at all the companies, only Adani Power has 4.3. I mean, though it is have a good amount of leverage, but beyond that, only Reliance has 5.29. Is that okay? So how it is calculated? So we can just go back and see. So this is the Reliance. Okay, fine. So here we go to profit loss account. Fine. So look at the profit loss account. Fine. So companies, interest is given. Okay, how much interest company is paying? How much? 22,588. This is the interest. So how much profit the company is earning? So we look at EBIT, that is earning before interest and tax. So the earning before interest and tax. So we have profit before tax as 98,000. So I can just calculate this. So just tell me what was the earnings. Just read this 98,704. 98,704. So 07074. Is it? Okay. So this was, the profit before tax. Fine. Is that okay? So now I just add interest to it. Fine. So what is the interest? Double two, five, double eight. So this is the interest. So if I have to calculate EBIT earning before interest and tax, so I have to just add this up. So company is earning 1,20,000 rupees before paying any interest. And what is the interest? So let's just go back here and see. So just let me just check profit before tax. I have added interest. Okay, only added interest. Fine. And of course there is something called other income also, isn't it? अच्छा ये तो इसमें added ही है ठीक है. So now I just go back and calculate interest coverage ratio. Fine, which will be earnings divided by interest. So I get 5.34. So for Reliance is coming out to be 5.34. So let me just check. So it is coming 5.34, isn't it? Have you got it? Okay, I'll just show you again. What I took was profit before tax. Profit कितना कमाया कंपनी ने before paying any tax, which was 98,000, which is given here, which is 98,074 profit before tax. So interest has been deducted to calculate that. So I have just added interest. Okay. So to get earning before interest. Okay. I'll just show you why I have used earning before interest. This is earning before interest and tax. What is the operating profit of the company? Now this is called operating profit of the company. So that means how much company is earning by carrying out its business. Okay, it's earning 1,20,000 crores. Okay, whereas it's paying 22,000 interest. So what I did was I divide the interest, sorry, EBIT divided by interest. So this is, if you look at the formula. So yeah. So I should put my cursor here. So this is the formula. Okay, 1,20,000 divided by interest. Is that okay? So this way you can calculate, earning interest coverage ratio of each and every company, and the company which are above 3, we consider them good companies. That means that these companies are not going to fail. The failure rate will be very less because they are earning 5 times more than what interest they have to pay. So which means they are very comfortable. They will always also enjoy a very high rating. Okay, so today we are going to talk about how the ratings are assigned by, whether this will be a AAA rate company or now if you look at Reliance, for example. So if you look at Reliance and go to documents here, go to documents and look at credit rating of the company. So company has AAA rating because it is a very good company. It is, solid company. It is increasing its revenue, increasing its profit every year, and it has a good ICR. Go to Reliance and go to documents. Okay, and then go to the credit ratings, and you will get this. So very recently company Chrysler AAA stable assigned to non-convertible. Now this rating is given for all the loans which company takes. Okay, the company is taking loans, so every time the company has to take a loan, it has to get itself rated before it can go ahead and take loan from the public or from the financial institutions. Because when it goes to the bank, it has to say that I have got AAA rating. So banks are assured about the money which they will be, they have to take, when they're paying, so they are assured about the interest and the principal. Okay. So recently, they have taken a bank loan facility of, 1 lakh crore, where the Chrysler has given a rating of AAA. Okay, which has been stable and which has been reaffirmed. That means it has already been taken it is a AAA company, so they reaffirmed the rating. The company is still AAA company. Rating कैसे? अभी आएंगे जब कॉस्ट ऑफ डेट करेंगे तो उसमें आएंगे. अभी वी आर जस्ट गिविंग यू when we go to first, we'll understand what is cost of equity, then cost of debt, then we are going to calculate the weighted average cost of capital, and then we are going to understand how the ratings are given by the credit rating agencies. Is that okay? Fine. तो अभी तो हम अब चले ही हैं, कहानी अभी शुरू हुई है. So we'll talk about the rating, how it's determined later on. Okay. Is that okay? Okay. So at the bottom, if you can just search this, if you can go, there is a, Google, that what is the ideal interest to coverage ratio. So there's some kind of, write up there that you can do if you want, not now. Otherwise,